Aaron Kennon, Clear Harbor Asset Management, writing the abrupt shift in the administration's approach to negotiating can lead to high bouts of volatility. With that said, we continue to believe there are opportunities across the investment landscape. Aaron joins us now for more. Aaron, welcome back, sir. Let's talk about that word, opportunities. Where are they right now?
Well, certainly, if you look across the equity landscape, you were just focusing on AI. We still think that there's a rather significant build out ahead, and that really this idea that, the data center hyperscaler spend is peaking in 2025, and that therefore there's no investment opportunity beyond that because we're just going to see a rate of change that's decelerating. I think really, it misses the broader point, which is that there's going to be great opportunity and productivity gains within the equity landscape across software. Semiconductors may become more commoditized in this debate, but the design of semiconductors, the build out of the data centers, the cooling of the data centers, the need for electricity. The IEA put out a report that projects that electricity demand just due to data center expansion is going to double by 2030, and that in the United States, between now and 2030, our demand for electricity is half of that demand growth is going to come from data center growth. So there's huge opportunities across the energy landscape, the infrastructure landscape, and then of course the technology landscape. And then of course, more broadly, if you look overseas, we think there's huge opportunities still in Europe. We think there's an opportunity in Japan. There's a lot of reshoring of capital there, and you've been discussing that as it pertains to the long bond, and then the rising middle class in the emerging markets. So we think there are some very macro, strong tailwinds ahead of us.
Let's pick out two of them. So let's deal with tech, and then we'll get to the debt market. Let's deal with tech first, with NVIDIA earnings coming up a little bit later. The benefits of the technological progress, from the stock's perspective, will they be concentrated in the big tech names, the Mag 7, or will we see those benefits more pronounced in the S&P 493 in the years to come?
My view is we're going to see a broadening, and I think that broadening is because you're going to see the trickle-down benefits of the build-out. And the recipients of the build-out will be the hyperscalers and the data centers in the early innings. And then the latter innings, we're going to see the trickle-down benefits permeating the manufacturing floor. We used to talk about lean manufacturing. You apply AI and robotics, it takes it to a different level. You think about sort of the hospitality sector and applying AI there, or healthcare, as you referenced earlier, in AI as it pertains to robotics, and increasing hygiene and increasing outcomes in a more positive way. So we think there's just a huge opportunity set in that regard.
Aaron, it really raises the question about whether the risk is shifting away from the stock market into the bond market. If you have margin improvements over the long term, not necessarily the short term, if you have efficiency, productivity gains at a lot of corporate levels, at the same time that you have a real churn on just the base of people who live in a country, and this question about the overhang of debt, do you see a better, less risky prospect in stocks right now than in government bonds?
Well, one is not able to live without the other, and the cost of capital certainly impacts the vast majority of the equity market, and we always have to keep that in mind. But if you think about the glass half full component, I mentioned Japan earlier. When you have rates trending higher, that yen carry trade disappears. Capital is brought back to Japan. It's not just Mr. and Mrs. Watanabe's capital, it's also institutional capital. And so that reshoring can augur very positive tailwinds for the financial sector and also for other areas of the economy. But for certain, in the United States, we should be concerned about higher deficits and what it means for the long end of the curve. But we should also keep in mind, too, that the average maturity of the outstanding U.S. Treasury profile that exists here in the United States, our $36 trillion debt, is about 5.5, 6 years. It's not the long bond. It's not 30 years. That's about 17% of our outstanding Treasury debt. And I think we need to keep that in mind as well.
What's driving the bond market? And I mean, you reference this question of issuance and maturities. Is that the issue? Is it inflation? Is it some sort of shift of cash away from U.S. markets to domestic markets, as you were referencing with Japan?
I think it's multivariable, Lisa. To be honest with you, I think it's a concern. At the end of the day, if you look at countries where we have a trade deficit, are not just buying our treasuries because they like us. They're buying our treasuries because they're trading with us. And if there's a tendency for us to trade on the margin a little less with countries where we have trade deficits, they're going to have less incentive to own treasuries. So that would be a little bit of a headwind. Our deficit projections at 7-8% deficit to GDP, that's not a positive tailwind, particularly for the long end of the curve. The front end of the curve is more controlled by the Fed, as we know. And so that's why we have, a rather significant disparity right now between, front end yields and long end yields. But, multifactorial for sure.
You're touching on a really important dynamic, though, a really important process, Aaron, which is at the moment we don't want their exports, but we want their capital. Can we have one without the other?
Well, I think this is a wake-up call to that reality, and I think there may be a longer-term thought that maybe the savings rate in the United States can move up so that what happened in Japan since the late 80s through about now, which is that the savings rate really rose markedly, even though it's a developed nation, could somehow be reflected back here in the United States where individuals start to save more and buy more in the form of treasuries. I think we're a long way away from that right now, and I think that's one of the challenges. Every 75 basis point rise in the total weighted average cost of our treasuries is about $275 billion. I mean, that was our Navy budget last year. So big challenges if we don't get this under control.
Well, for every spending, every $7, one of those dollars in the U.S. spending goes to paying off our net interest. Amidst all this policy uncertainty in Washington, of course, we have the one big beautiful bill as well. Do you find that this bill is a tailwind or a headwind at the moment?
Well, in the short term, when you look at where we thought it was going to be 2 months ago, it's now representing stimulus, where we thought it was going to represent more of a Doge-lined, sort of bit of hawkishness. And maybe contraction. And that's why I think some of the commentary just a few weeks ago and months ago, and I was articulating this was, well, we're going to have a lot of stimulus in Europe, but we're not going to have a lot of stimulus coming out of this bill in the United States. And so therefore, maybe want to reallocate capital to European equities. Well, we're going to have about $300 billion of stimulus if this bill passes. I think in the long run, though, will this create a Liz Truss moment in the short to medium term, which is going to cause problems for our deficit in the long run? We'll have to see. Will those bond market vigilantes come home to roost?
Just to jump in here, what do you really see as stimulative? Because isn't this just an extension of current policy?
Yeah, I think if you look at, some of the extension of part of the IRA, it's still stimulative. You're right. If you look at the extension of the Tax and Jobs Act, it's still it's about as is. But if you look at the provisions around interest for your property taxes at the local level and the increase in standard deduction, things like that, it's incrementally stimulative. I think it's considered about $300 billion the last I saw. But again, those senators are there are 3, 4, 5 Republican senators who are no-go on this. So a lot can change between now and, let's say, the vote.
Aaron, appreciate your time, sir. A lot can change. Aaron Kennon there of Clear Harbor Asset Management.